If you're willing to take some time to learn some empowering definitions, then making debits and credits will be one of the easiest things you have ever done. In this video, we're going to learn the definition of 6 simple word phrases, and we're going to take our time and thoroughly discuss it so we're absolutely sure we know what they really mean. The first definition we will learn is income from service. It's a T account that we use to record each event when we earned income from a service. A service income is money you earn for doing what you normally do in business. Of course, you don't only have to have a service business, you could have a merchandise business. And you would earn income in a merchandise business at the moment you deliver the merchandise to the customer. You earn income in a service business at the moment you deliver the service. There's one T account that you should record all the income, which means all the money that comes in from that particular service. And it's very easy to record it in the T account. Income will only be credit, never debit. That means if you're recording income and you record each event where you've done a service and earned income, you should see transactions listed only on the right side, the credit side, because that's the way it goes. And I'm going to show you the reason for that a little later in this video. And now I will introduce you to a very important account when we study accounting. This account is called accounts receivable. Accounts receivable is the total money that all customers owe you for selling them stuff or doing stuff for them, like the income that we mentioned a moment ago. If Alan owes you $30 for delivering a service in the past, and Betty owes you $40, and another customer, Candy, owes you $50, then in that case, the balance of accounts receivable, the T account, at this moment should equal $120. That's the reason for it. It equals the total balances of all customers at any given moment. So, accounts receivable is an asset because it represents money that you will receive in the future. And as you know, assets are plus for debit and minus for credit. That means if a transaction requires that you write down you will receive more in the future, you'll put that on the debit side. But if you will receive less in the future as a result of a specific transaction, then that transaction would be listed on the credit side. So if we take a look at an example, if Alan did a service, if we did a service and Alan promised to pay in the future, well, that means you will receive more in the future. So the account receivable account will be debit because it's plus. You will receive more in the future. And of course, the other account will be credit. And in this case, like usual, it'll always be income credit. Now, what about this? We did a service for a different customer. Even though we did a service for a different customer, it should still be debit for accounts receivable because that customer promised to pay in the future. So the total money that we will receive from all customers in the future will be more as a result of transaction B. So transaction B is debit. However, if we have a transaction that requires that we decrease accounts receivable because the transaction means that we will receive less in the future as a result of that transaction, then we would have to make a credit. So if one of the previous customers who owed money pays some of the money, that would be accounts receivable credit because we will receive less in the future. So even if a different customer paid, Any customer who pays, we have to make a credit to accounts receivable and a debit to the other account involved in the transaction. Usually cash, because we got more cash. But this is how accounts receivable behaves, and it will be matched to each individual customer's balance, so that the total of each individual customer's balance will always equal the balance of this T account, accounts receivable. Now, most people already know the definition of this next word, expenses. You could think of them as the opposite of the first definition that we learned in this video. Expenses are like the opposite of income. Income is money that we earn for performing a service. Expenses are money or monies that we must pay to be able to earn the income. If we don't need to pay the money in order to be able to earn income, then it's not a valid business expense. And of course, we would not write down all the expenses in only one T account. If we needed to pay for delivery in order to earn income from our customer, we would record all of the deliveries and only the deliveries in a T account called delivery expense. If we had to pay for repair in order to service a customer, we would record all of the repairs, or rather each time that we paid for a repair, we would record that instead into this account, repair expense. And expenses are only debit, never credit. So if you are recording your expenses and you look at any of your expense T accounts in your general ledger or your chart of accounts, you will see only transactions listed on the left side, never on the right side, because expenses are only debit, never credit. Remember, expenses are like the opposite of income, and earlier we learned that income is only credit, never debit. So expenses are only debit, never credit, and I'm going to explain why at the end of this video. And just like expenses are the opposite of income, accounts payable is the mirror opposite of accounts receivable. Accounts payable is a T account. It is a liability, and it represents the total money that your business owes to people or companies who did a service for you. For example, if you owe Rex Repair Shop $30 for a repair service, or you owe FedEx $40 for a delivery service, then that means the balance in the T account, accounts payable, should equal $70. It represents the total money that you owe to all vendors at any given moment. Accounts payable is a liability. That means that it's minus for debit and plus for credit. So, if we have a transaction that requires us to increase what we will pay in the future, then we will make a credit to account payable. Even if that transaction is from a different vendor, we will still make a credit to account payable and a debit to the other account, usually an expense like a service that we received from a vendor. Of course, if we record a transaction that reflects the fact that we owe less to our vendors in the future, then for that transaction we would make a debit because we would pay less in the future as a result of that transaction. Of course, the other account involved would be a credit, usually cash, if we're paying off some of our vendors. So that's the way accounts payable would behave in the general ledger when you record your debits and credits. And finally, I will clarify the proper way that owner's equity transactions should be recorded. They should not be recorded the way I demonstrated in previous videos. Of course, we don't have only one T account to represent the entire category of owner's equity. I only showed it that way before just for you to get the idea. The real truth is that there are two separate owner's equity accounts, One is called owner's capital and the other is called owner's withdrawals. Owner's capital is the T account where we record the owner's equity transaction when the owner invests any asset, cash or equipment or anything. When the owner invests any asset, we record that only in the T account capital. And we always make a credit because capital is always plus to owner's equity because all it represents is what the owner put into the business from his or her personal pocket. So that's why capital is always a credit, never a debit. Now the exact opposite of that account is the one right here on the left, withdrawals. This account will record any time the owner takes out any asset from the business, whether the owner withdraws cash, equipment, or anything the owner removes from the business to be used for non-business reasons would get recorded in this account on the left, owner's withdrawals. And every time the owner withdraws any asset from the business, the owner has less owner's equity. So withdrawals is always minus to owner's equity, and therefore you have to make a debit every time the owner withdraws money or asset from the business. In fact, you could even say that withdrawals is always debit, never credit. Now, in closing, you should know that owner's capital and owner's withdrawals are not the only accounts under the category of owner's equity. The other two accounts under the category of owner's equity are the two accounts that we learned about right here in this video. Both expenses and income are also technically under the category of owner's equity. That's because expenses always make owner's equity go down because the person responsible for the expense is the owner. And income always makes owner's equity go up because if a customer gives money to the business, it's the owner's money that the customer is giving after the sale or after the service. So these four accounts are technically under the category of owner's equity. And they make debits and credits very easy. I hope that you will use your accounting textbook to understand a little bit better why these accounts are under the category of owner's equity. But if you have a transaction with any of them, you should always know what to debit and what to credit. If one of the two accounts in your transaction is either withdrawals or an expense, you will have to debit the withdrawals or expense and credit the other account. If your transaction requires that you use the owner's capital account or the income account, then you know for sure you're going to make a credit to either income or capital, and the other account in the transaction should be debit. So now your adventure of debits and credits should actually be easier by understanding the meaning of these four items under owner's equity.